Let's start off with the figures we need to talk about, which is one, inflation down to 5.32% in September. Is the worst behind us? This looks very good from where I sit.
Yeah, I wouldn't say the worst is behind us. Right now, the inflation is being driven not really by a reduction in prices, but due to the base effects of last year.
Right.
Because the CPI was very high, at least, and it peaked at around December last year. So we could see some of that base effects still affecting inflation. And ultimately, I mean, if this current trend continues, we could be in a situation where there's actually disinflation, where the inflation rate is negative. So I think not too much is to be read into these figures, and we should wait for around December, January this year, when the base effects have kind of worn off, so we can start seeing the inflation picture. But yeah, so far so good.
So what you're saying is that we might be looking at the almost reverse of what we have right now, where food prices keep falling and if prices of key commodities keep falling?
I mean, in terms of key commodity prices, I don't think we're out of the woods yet.
Yes.
We've seen the oil prices that has been very stubborn at around $110 to $116 a barrel, and food prices due to the US drought are kind of on the rise. So what I'm saying is that the base effects of last year will make inflation look good, but going forward, once those base effects wear off, they could start seeing a gradual rise in the inflation rate.
At least on the face of it, this gives more credence for the central bank's MPC to keep cutting rates.
Yeah, it does give a lot of credence, and the fact is it's approaching its long-term target of 5% inflation.
Right.
And that's a key policy target. And on the basis of that, then there's a strong argument for a reduction in the CBR. But I don't think the reduction would be as aggressive as it was 2 or 3 months ago, because the main thing is that now the shilling is under pressure. And we might, if there's more pressure on the shilling, we could see imported inflation like we did in around Q3 of last year.
Just to draw that line from the correlation between inflation that's falling down, yields are coming down, and how the shilling might suffer as a result of that.
The thing is that the yields right now on government securities need to be sustained at just below 10%, around 9–10%, because if there's a significant fall, then we could see a flight out of the local debt market by foreigners, and that will put a lot of pressure on the shilling. And that's why I'm saying that the CBK needs to be very careful how it manages the reduction in the CBR, so as to ensure that we don't see a flight out of the Kenyan shilling.
Okay, the shilling is where it is, holding steady at least for the moment. Yeah. But on the other hand, I need to bring in the GDP picture, which is we have the slowest growth in Q2 since Q4 of 2009 at 3.3%. Were you concerned when you saw this figure?
Of course it's not a good figure.
Yes.
But it was expected, because what happens is that typically in sub-Saharan Africa, growth, even globally, the economy reacts with a lag to monetary tightening, and that lag is between 9 to 12 months.
Yes.
And once we saw the CBR touching 18% last year, then it was going to affect growth, because what happens is that businessmen reduce their orders for machinery, manufacturers reduce their output based on the high cost of financing, and that's what we are seeing so far in the growth figures. We saw manufacturing contracting, agricultural contracting, and that is expected to wear off now once the CBR starts falling down. Because
agriculture accounts for a quarter of the entire economy, so anything that affects that is definitely going to affect the overall global picture. There's one aspect of this, which is the high borrowing rates, and construction, for instance, directly depends on how much builders and developers can be able to take a loan at good rates.
Yeah, and exactly. We've seen a lot of real estate developers actually, and even in my conversations with them, significantly reducing the size of their projects. Some are even reducing lowering the quality of the finishing, just to ensure that the units are sellable. So we've really seen an effect of the high interest rates on the market.
What did you say you're expecting for Q3? Because I will put you on the spot when Q3 comes and we get those figures.
With regards to growth?
Yes, with the GDP growth.
We could see it still at around 3 to 4%.
Right.
And it was largely expected, because Q3, remember, Q3 is still only a year after last year's tightening. And so we'll still see a slowdown in the growth. But maybe we could see a pickup in Q4, and Q1 of next year. Yeah.
Excellent. Moving on to the Nairobi Securities Exchange, the NSE touched a new year high for the 20-share index anyway at around 39.80. Though by the time the week closed, it was back again, only up 1.1% week on week at about 39.72. What do you make of the index and where it's moving?
I think what's happening is that people just don't, there are too many variables to be read in the market.
Yes.
Inflation right now is dropping, but the exchange rate is still weakening. We are seeing yields drop, but the economic growth is contracting. So there's a lot of conflicting news reports, and that's why we're seeing a lot of sideways movement. Going forward, maybe the fact that the inflation is coming down and yields are falling could give impetus to the NSE to even touch the 4,000 mark, as you mentioned. But there's no strong catalyst for a real rally at the moment. And as I said last time around, that up until the elections are over, we won't see any significant movement in the NSE because there's that huge political risk factor affecting the market. So hopefully going forward, we'll just see it playing around the 4,000 mark, but nothing significant thereafter.